This presentation on auditing is the third part of our introduction to the regulatory context of business. In this presentation, we outline the role of auditing and talk about what an audit is and also what an audit is not. And in doing that, we close off a widely held but incorrect expectation gap. Now, a very important consideration here is the role of external auditors. Any company listed on the stock exchange must be audited. That's mandatory. Many companies within the business world must also be audited, and they will not necessarily be listed on the stock exchange. Some private businesses will be audited if their owners deem that to be appropriate and of value. Now let's just talk about the role of external auditors of general purpose financial reports. Again, these are the reports that you and I will read outside the company. So you'll be reading the Woolworths general purpose financial reports. Now, what's really important for auditors to be able to do the job properly is that they are independent of the entity. Independence has got some precise definitions and some precise meanings, but again, for you and me, the general meaning is pretty clear. They are able to express an opinion about the accounting and the presentation of this data without being subject to other agenda which might cause them to moderate their opinion in some way. So they express an opinion that the general purpose financial reports are a true and fair representation of financial status and financial performance. Now, to be able to do that, amongst other things, they have to be able to tell us that their accounting systems complied with the requirements, and they also have to be able to tell us that they've done sufficient work within that system to be able to confidently say that they're following proper accounting process. Now notice that external auditors don't prepare the accounts and the reports, they audit them. If they prepared them themselves, then they could not independently audit them because they're auditing their own work, and we would say that that's not a certain way to get a clear, unbiased opinion about how good they are. This gives rise to what is generally referred to in our community as an expectation gap. Some people in some organisations actually believe that auditors check everything, and that if the audit report is what's known as a clean report, then everything is okay and it's 100% okay, and the auditors are saying this is a great business and you can have a relationship with that as an investor or as a supplier or as an employee without any concerns. Well, we need to be careful because we've just seen that they don't check everything and that there are some things that they're not required to do. So what don't they do? Well, we've already seen that they check only a sample of transactions, not all transactions. We've already discussed that they don't do the accounting, they audit what others have done. And importantly, this last bit, they don't form an opinion about the performance or health of a business, unless at the extreme they come to the conclusion that what they're looking at here is no longer a going concern. In other words, it cannot continue to trade because it's going to run out of resources, and usually the first resource that they run out of is money. So be very clear here, a clean audit report does not tell you or me or anyone that this business is a fine business and that it's a good investment. Those are decisions that you and I have to derive ourselves based on our own analysis. And the input to our analysis is the audited financial statements. But auditors don't give us the opinion or the assessment that this is a great business. Auditors bridge a believability gap between what businesses tell us in their self-constructed reports and what external users hope that they are reading. Or put another way, we can say that auditors tell us that we can have confidence that what we are reading is complete and compliant with all the rules. For users to have that confidence, they must have confidence in the auditors.
Which brings us back to the need for auditors to be independent. Their independence of management and of the business allows them to form and report objective opinions without bias. We've seen the corporate failures that were able to occur when audit independence was not present. The Enron collapse in the US was successfully kept secret for a long time by auditors who were not independent. Australia's largest corporate collapse, HIH Insurance, was also kept invisible until the last moment by auditors who were not independent. Independence of auditors does not change the fact of corporate failure, but it does make it visible much earlier, allowing stakeholders to take appropriate steps to manage their own risks. These and other failures inevitably fueled community outrage, to which regulators responded. The profession responded by committing to rigorous training and reporting against independence standards. Regulators responded with legislation known in Australia as Clerk 9, that stands for Corporate Law and Economic Reform Process in its 9th version, and in the States the Sarbanes-Oxley legislation known as SOX. The legislation in both locations is similar in focus in that both require that audit partners rotate after 5 years of being in charge of a particular audit. In order to establish independence, we can now look financially at the fees which are paid to audit firms, and the signal here is to look at the total fees and to establish that the auditor is not receiving a greater amount of remuneration for non-audit activities than they are receiving for audit activities. And finally, there are barriers about cross-hiring, so it's no longer possible within a couple of years to, for example, hire the CFO from an organisation into the audit firm.